Welcome back. It is a big week for economic data with Fed minutes due out Wednesday. We'll also get a look at the health of the consumer with Home Depot, Target, and Walmart reporting this week. And we did start off with some really good news this morning. The August Empire State Manufacturing Survey posted its strongest reading since December of 2021. Much of that driven by AI infrastructure spending, yes, right here in New York. To help break down what investors need to be looking for this week, let's bring in Gina Martin Adams, Chief Market Strategist for HB Wealth. Gina, that Empire, I know it's regional, but that Empire Manufacturing Survey, I mean, wow, were you surprised?
Incredible number, and not a tremendous surprise because it's happening nationally. Yes, it was a regional number, but it really confirms what we've seen in the ISM surveys. The PMIs broadly have been improving all year. As a matter of fact, we've had 7 consecutive months of expansion in the ISM survey. That's the first time we've seen such a thing since 2023. As this concentrated investment spending has moved kind of beyond just technology into infrastructure investments to support the AI build out, as well as energy investments. It's really filtering throughout the broad economy, resulting in elevated activity in the manufacturing space.
Is that being underappreciated by parts of the market?
I think in some ways it is, in some ways it isn't. It's interesting because we have this really skeptical market, I would say, is the way that I would classify this market.
Everyone thinks the spending is all circular and it's going to be like the dot-com bubble and it's going to break.
But if anything, we're always wondering, when is it going to end? Is it going to end? How bad is it? What is all this debt? You know, those are the questions that we're asking. And the reality is it may just be getting started. We're just starting to see revenue growth, for example, from the cloud companies on the heels of some of the AI investment that had emerged starting in 2023.
We're just getting started means we're in what inning in a baseball game?
Yeah, it's tough to say, but I would say we're not even supposed to see revenue growth to surpass capital spending until 2029.
Oh, wow.
That's a full 2.5 years from now.
Okay.
So we're in the very early innings. The AI investment trends really started in 2023.
Okay.
So we're only in our 3rd year here. We're just starting to see this become a broader economic phenomenon. And in the end, it's supposed to be a bigger economic phenomenon than any investment boom. Bigger than railroads, bigger than the telecom fiber build out, bigger than electrification. Is just in total numbers and sheer economic impact, this should be the biggest.
I'm getting these numbers from HB Wealth.
Yeah.
Last year, AI CapEx accounted for 1.3% of U.S. gross domestic product. It's on track to account for 2.5% of GDP this year. Would the economy not be growing if it wasn't for AI infrastructure spending?
It would have not grown very much in 2025, almost zero growth in 2025 without AI. This year's been a little bit different because the consumer did kick in a little bit of growth. And this year is a little different as well because that AI spend is starting to filter through to other segments of the economy. We see this most profoundly in S&P 500 earnings. A year ago, you had 4 sectors in the S&P 500 actually producing earnings declines, 4 of the 11. So only 7 sectors were producing growth. Almost all of that growth was coming from the technology-specific segments of the index and very, very slow growth elsewhere. Flash forward to where we are today, 10 of 11 sectors are producing earnings growth. By the second half of this year, healthcare will also be producing earnings growth. As a result, you've got all of the economic sectors firing in the S&P 500. This is a function of that investment spending starting to filter through to the broader economy. It's starting to actually have positive impacts in the rest of the economy. The market, in some ways, interprets this as a vulnerability, but it is also a very big strength. As long as that investment results in revenue growth, it can become a self-manifesting economic recovery story. And I think that that's where we are today. And it is still somewhat underappreciated.
Ed Yardeni is predicting S&P 10,000 by 2030. What you're saying is making me think that you agree.
I mean, that's not a tremendous stretch. We're already near 8,000 on the S&P 500. So
what is Gina saying?
So it doesn't seem like a tremendous stretch to get there. I think on average, when stocks go up, they go up somewhere between 10 and 15% per year.
Okay.
As long as we continue to see this earnings recovery and we continue to see the companies spending, we will likely see stock prices continue to go higher. There are always risks to that thesis. We need to certainly monitor what's happening with debt. We need to certainly monitor the balance sheet of the hyperscalers and revenues.
Are you worried about the U.S. national debt I mean, just tens of billions of dollars away from hitting $40 trillion for the first time.
I am worried about that. I think that that is one of the most profound risks that we have to face, is that the debt concerns filter through to the economy as well as the equity market through a crowding out effect. The debt concerns can become overwhelming, especially when interest expense is rising faster than government revenues. So we do have to address the debt situation. Now, in the past, the U.S. has been in a wonderful situation where we can grow our way out. And that very well may be the case over the next 5 years, but I don't know if we can always rest on those laurels. And we're not necessarily addressing the debt, and that's showing up in the longer end of the curve. You know, the negative news over the last week was the auctions of the 10-year and 30-year Treasury yield
Generational
bonds.
highs.
Yeah, we're looking at a 30-year that is priced at levels we hadn't seen since 2001.
5.2%.
So we do need to pay
to some
attention
people,
to this.
though, that yield?
I think it is to some. There is risk in that, though. Look, that's still a lower yield than most of the 1990s. The 1990s is this reference period that we all go back to with the big tech boom and the telecom fiber build out. So should yields today be lower than they were in the 1990s is a really big question just on economic considerations. But when you look at the debt levels, it looks like yields are only going higher without some sort of intervention. So we do need to account for that. And that means valuations are probably somewhat constrained. Our market outcomes are dependent upon earnings growth continuing to follow through. That's been the story this year. We started this year with higher valuations than we have today, despite the fact that we have this earnings phenomenon.
Yeah, I'm glad you used the word phenomenon, because earnings growth has been the backbone of this stock market rally and this economy.
Absolutely. It's been actually quite amazing to see this market produce greater than 30% earnings growth in the middle of an economic cycle is incredibly unusual. You normally don't see that unless you're coming out of recession or the one phenomenal year of 2018 when we had tax reform. Taxes reduced, the result was acceleration in earnings. So this is a earnings phenomenon that's built on the heels of an economic phenomenon that looks to have some legs, frankly, at this point.
Unfortunately, we're kicking off the week to the downside. The S&P is down about 30 points, but we love the positivity. Gina Martin Adams, thank you very much.